Good day, everyone, and welcome to our Lead Impact series. In this hour, we're going to be spending time with Professor Michael Pettis, who is in Beijing at the University of Peking. And we're going to take a look at the situation in China and where things are today and where we think things are going to go over the next number of years. Let me first get started by doing a brief intro of Michael and his bio. He is a professor at the University of Peking in Beijing, and he has been there quite a length of time. He started in the investment industry. I will find out from Michael exactly what year he came into the industry, but I would think it was about in the 1980s. Just recently, he did a significant long interview, which you can find on YouTube, regarding China's economic growth model is dying. Specifically, it raises the questions, is the Chinese miracle economic growth over? And if so, what is next? And this is a slide that I had presented to our recent market outlook regarding massive differences between major countries and China, specifically as it relates to consumption. So you can see here that the percentage of GDP for consumers in China is very significantly lower than it is for other countries, including countries, let's say, with a lower per capita GDP, such as India. And the question really is, well, what would be required for China to move into the zone, that 70% zone versus the current area, which is barely above 50%, for Chinese growth to continue in a sustained fashion. Dr. Pettis has written two really great books. The first one I read it came out in 2000 and I believe 12 or 13, called The Great Rebalancing. And back in 2020, he wrote a book with Matthew Klein called Trade Wars or Class Wars, and we certainly want to get into that. If you want to get some sense for the second book of what it's about, there was a great article written by Martin Wolf in the Financial Times about 2 or 3 years ago. It's certainly available online, and it talks exactly about the premise behind these books. So with that in mind, let me introduce you all to Dr. Michael Pettis.
It's a pleasure to meet you, John.
It's a pleasure to meet you, and I'm a big fan, and I really enjoy listening to your. In fact, when I on your first book, I actually bought the audio book because I found it was easier for me to actually understand, because the audio book was slower, because the concepts that you raise are actually fairly complex, and it's a little easier to get your head around them when you're listening on a measured pace. And one of the things I wanted to ask you was, because you started in the investment business, how did you morph your way into becoming, a highly qualified professor of economics at China's most prestigious university?
Well, I think like all of our careers, it's more about luck than about clever planning.
Mm-hmm.
When I got out of a business school, I got my MBA at Columbia. I wanted to go into Latin America, but that was in the late 1980s, during the period of the debt crisis, and people just laughed. They said, we don't pay MBA salaries to do Latin America. It's dead and it's never coming back. And so I ended up working with Mellon Bank, which was one of the two AAA banks back then, focusing on Japan, which was the really hot market. And I was very lucky. I sort of stumbled into a portfolio where I ended up building relationships with Japanese broker dealers. And that was considered, the hottest place to be, because of course you'll remember back in the 80s, everyone knew that Japan, the Japanese banks were going to take over and blah, blah, blah. But I read an article about these weird people doing debt equity swaps in Latin America, and I'd always wanted to do Latin America. I partially grew up in Peru, so I managed. I wrote to everybody in the article, and I finally got somebody to interview me, and I got hired to do debt equity swaps in Mexico. And I became a trader, and the whole thing really exploded. Again, it wasn't planning. most smart people thought, leaving Japan and going to Latin America was idiotic. But it turned out,
Yeah.
very lucky timing
Well,
because Japan.
yeah,
Yeah,
in 10 years. It was weird back because people remember, well, of a certain age remember, there's the Japanese buying Pebble Beach, there's the Japanese buying Rockefeller Center. It looked like it was really, it
right.
really was a point in the 80s. People said, Japan will take over the US.
Yeah, it will become the biggest economy in the world within a couple of decades. The yen will dominate international trade, blah, blah, blah. All stories we've heard before. We heard this about the Soviet Union too, by the way, and then
Yeah.
more recently about China. So it was a really great lesson. And one of the important lessons was how terrible we are at planning, because everybody knew that Japan was the future and Latin America was the past.
Mhm.
And within a couple of years, Japan became the past and Latin America became the future. It turned around very quickly. So I spent many years running trading and capital markets desks for various Wall Street banks, focusing primarily on Latin America. And it was very exciting. Everything was new. Every deal that I did was, the first time it had ever been done or the second time it had ever been done. But by the end of the 90s, the Latin American market had become emerging markets, and it had become a real cookie cutter sort of a market. Everything was the same. And quite honestly, I got a little bit bored. By that time, I was running Latin American capital markets at Bear Stearns, and I got a little bit bored, and I thought, I'd like to go either to India or China, two countries I know nothing about, but not as a banker because bankers work too hard. I'd like to go as a professor so I can learn about the economies. During this time, I'd been teaching courses at the Columbia Business School and at the School of International Affairs. And so I was very lucky. I managed to get an offer from Tsinghua, which is the other of the two really famous universities in China. And I moved to China. The plan was to go there for 2 years and then return to Wall Street. But it turned out to be an awful lot of fun, lots of things happening. And I stayed here 21 years.
Yeah, that's great. Well, yeah, in a recent interview you did, you talked about, you've talked a lot about China's growth, the pluses and minuses of it, but in the interview, you compared it to, things that occurred, you mentioned with Japan, also Brazil, Germany, and Russia. So can you expand on what the Chinese growth model actually is?
Yeah, this is one of the advantages I had when I came to China, because like in many big countries, the China experts sort of think that China is sui generis and that what happened in other countries has absolutely no relevance here. We hear that a lot in a lot of different countries, and of course, as you know, that's nonsense. Historical precedents are always very useful, and so I came in with a strong background in the sort of the financial history of Latin America. And so I knew this model quite well. It was a model that a number of countries, most famously Brazil, implemented in the 1950s and 1960s. You could say it was invented by Germany and the Soviet Union in the 1930s. But since the Second World War, about 24 countries have followed this model. And basically, the way the model works is you want the country starts off massively underinvested. It could be because of war, so Japan after World War II, the Soviet Union after World War II, or it could be because they're developing countries and they simply have trouble accessing capital. So the focus is to raise investment levels as high as possible. Now, if you want to invest, you need savings. And the traditional way has been for developing countries to import savings from abroad. So the US and Canada in the 19th century imported a huge amount of savings from Europe, primarily England, which allowed them to invest far more than they otherwise could have with their domestic savings. But that became very risky, in part because of the LDC crisis of the 1970s and 80s. So the argument was that if you want to minimize the risks, you should force up domestic savings. So you force up domestic savings, put those savings within the banking system, and then use that to fund enormous amounts of investment at very low rates. This is how the model works. And it's a very successful model when you're underinvested. And remember, when China began the reform period, it had gone through 5 decades of anti-Japanese war, civil war, and Maoism. So it was hugely underinvested. It had no subway systems in the entire country. It had 4 commercial airports in the whole country, et cetera. So this was exactly what the doctor ordered. huge increases in investment funded by huge increases in domestic savings. Now, how do you increase savings? A lot of people will tell you savings are a cultural factor. Some cultures save a lot and some don't. And that's all nonsense. Savings is simply GDP minus consumption, right? All of your income, you either consume or you don't consume. And if you don't consume it, we call it savings. So the trick is to get consumption down. And the trick in getting consumption down is give a very low share of GDP to that part of the economy that consumes. Basically, ordinary people consume most of their income. The rich consume a very low share, businesses consume none of their income, and governments consume a very low share. So if you can take income away from workers and middle class and direct it to other parts of the economy, automatically the savings rate goes up as the consumption rate goes down. This is what Germany did, for example, after 2003. That's Japan, South Korea, Taiwan. It's a common model. Now, is this a good thing or a bad thing? Well, what's really striking when you look at the track record of countries that have followed this model, every single one of them has followed three stages. First stage, really high investment, very rapid growth, and very healthy growth. The second stage, you continued with high investment and rapid growth, but now the growth became increasingly unhealthy and you started to see debt surge. And then the third stage was the adjustment process, which was always a very difficult process. And so seeing that that's what always happens, the logical thing is to think this is probably going to happen again. Let's try to figure out why it happens. And as you know, John, it's not really that complicated. A growth model, a successful growth model, and we've known this for a while, is by definition one that solves your particular problems, right? And the fact that it's successful means that it resolves them. And once it resolves them, it becomes obsolete. So a successful growth model, by definition, makes itself obsolete. The difficulty, and this is what Albert Hirschman used to write about a great deal in the 1960s and 70s, the difficulty is that it's very, very hard to switch away from a successful growth model because that growth model benefited certain constituencies disproportionately, and they became disproportionately powerful. And so they block any attempt to reverse the model or to switch away. And the result is that you go from being underinvested, you catch up to your optimal level of investment, and then you keep on investing. And you end up with spectacular infrastructure, but far better infrastructure than you can possibly absorb. And when that happens, you start to see the rapid rise in debt until the government either decides or is forced to constrain the growth in debt. And that's when you get the difficult adjustment. So this is a model we know quite a lot about.
Okay, so I mean, one of the things, because you mentioned it being primarily investment driven and also restrictions on consumption, and not sustainable, let's say, over many decades, but China still has a significantly lower GDP per capita than a lot of the countries that you were talking to. So is there some reason why China is not able to continue with this model to get to at least some semblance of, let's say, a Western standard or a Japanese standard or even a Korean standard of living on a per capita basis?
That's the most difficult and counterintuitive thing, I think, for many to understand. So you'll often hear in China, investment per capita is about 1/6 the level of Europe and the US and Japan. So therefore, by definition, you could multiply investment by 6 times to catch up to the US.
Mm-hmm.
The problem with that model is that it has an implicit assumption, and the assumption is that all economies are basically the same. They can all absorb the same amount of capital productively. But I would argue that's not the case. So, if you take two mountainous landlocked countries, Switzerland and Bolivia, obviously Switzerland is much richer than Bolivia. Is Switzerland richer because they have more investment per capita, or do they have more investment per capita because they're richer? And they're richer because they have the set of institutions that allow businesses and workers to behave at much more productively. I would argue the difference between Bolivia and Switzerland is not that Switzerland has more bridges, and if we build enough bridges in Bolivia, we'll get to Switzerland levels. I would argue the difference is really institutional, the political institutions, financial, business institutions, and that's really what determines the amount of capital you can absorb. So then the question is, what's the correct amount for China? Well, a priori, I can't really tell you, but I can tell you there's a good way to find out. And that is, if most of your debt is used to fund investment, then almost by definition, except over very short periods of time, debt won't rise faster than GDP. Because if your investment is productive, then your debt's going up, but your GDP is going up too, at
Right.
least quickly. When you start investing non-productively, when you start misallocating investments, so you take $100, you borrow $100, buy $100 of inputs, build something that creates $60 of output for the economy. Now your GDP is not growing as quickly as your debt. So you should start to see a gap between the growth in debt and the growth in GDP, and your debt to GDP ratio should start rising. That happened in every country that followed this model. And that happened in China around 2006, 2007, 2008. So I would argue that that's pretty strong evidence that investment is systematically non-productive.
So, since we're speaking about debt, maybe this is a good segue into the LGFVs, or the local government financing vehicles, which seem to be a requirement in order to actually fund or build infrastructure, and can only be funded by the sale of land, as opposed to any other revenue that local governments might raise. And the sale of land is completely plummeted as a result of the massive crisis in the real estate industry. So on that basis, that I read that the current level of LGFV debt is like 9 trillion, local debt, 9 trillion US dollars just in these vehicles alone, which is half of GDP by itself. So is that actually sustainable? And if it's not sustainable, does this mean it gets nationalized in some way?
It could even be more. The IMF thinks it's more. One of the big problems is that they've hidden a lot of the debt, so we don't really know how much debt there is. There's a lot, that much we know. But think about the creation of that debt, because the classic example has become Guizhou, a southern province that is among the poorest provinces in China. Mm-hmm. Guizhou is a very mountainous province, very beautiful, but it's very, very difficult terrain. And so they've addressed that problem by building some of the most spectacular bridges in the world in Guizhou. Of the 100 highest bridges in the world, 50 of them are in Guizhou. Of the 10 highest, 4 are in Guizhou.
Okay.
So the argument there is Guizhou is poor, let's build a lot of stuff and they'll get rich. If you believe that every economy, every entity has the same absorption level, everyone should be the United States, then yeah, that makes a lot of sense. But if you believe that the amount of investment you can absorb depends on your particular set of institutions, then the fact that Guizhou is so poor suggests that they can absorb less investment than some of the richer provinces, but they have much more. Now, if this investment was productive, if Guizhou needed all of these bridges, Guizhou's economy would have taken off. And the Guizhou government wouldn't have had problems servicing the debt, because as the economy grows, their tax revenues grow. But that didn't happen. The debt grew much faster than tax revenues, much faster than the underlying economy. So that left only one way to fund it. You couldn't fund the debt out of future tax revenues. So as you said, you fund it out of land sales. And that created a very precarious set of conditions, because as long as land prices were rising, you could continue misallocating capital. But as you continue misallocating capital, you undermine the whole economy, and eventually land prices will stop rising and they'll start coming down. In which case you get caught up in this horrible system where the only reason you were growing, you were not really growing from an economic point of view, you were growing in terms of economic activity, was because of this real estate bubble. And the moment the bubble deflated, you sort of doubled down. As the real estate bubble deflated, the ability to fund all of this infrastructure investment disappeared. And so they had to cut back on investment, and that worsened the economy. And that's where several provinces in China are today. They literally cannot repay their debt without somebody coming in and resolving it for them.
Right. So then, I mean, one of the problems it seems to me that local governments have, which is almost bizarre in a way, is that there are no real estate property taxes, as you would see in Europe or in North America, which is, from a local government perspective, pretty well the driving revenue source in those other jurisdictions. Is there some reason property taxes don't exist in China?
For years, they've talked about them, but when things are going well, it's really hard to implement these types of reforms. And so they never did it. And it's only been in recent years that they've said we urgently need to do it as an alternative source of income for local governments. The problem is that because of the deflation of the property bubble, local governments are really screaming for help, and they're trying to stabilize the real estate market. I don't think they can, but they can at least slow down the pace of decline. The problem is, if you impose real estate taxes, you'll probably cause the market to collapse. About a fifth to a quarter of all apartments in China are empty. People just buy them for investment purposes. Now, an empty apartment is a wasting asset, right? You've got to pay upkeep, you lose money, you've got to pay mortgages. So it's got a negative carry. But as long as prices were rising, you're still coming out ahead. It still makes sense to buy apartments and keep them empty. Now that prices aren't rising, it's become harder and harder to keep those apartments. And if you impose a meaningful property tax, the negative carry really becomes much higher, right? In which case, if you own an apartment, you're now losing 2 to 3% of its value every year between interest rates, property taxes,
right,
et cetera.
Yeah.
So what are you going to do? You're probably going to have to sell it. And if all of these apartments come on the market, the prices will collapse.
But that's interesting, because the title of your first book, Rebalancing, and the issue is that would be the normal market condition in terms of rebalancing. I mean, if you take a look at the U.S. housing crisis in 2006, that's exactly what had to happen. And it did in spades. I mean, not just in the U.S., in Ireland and Spain, you name it. So essentially, that correction took place, and therefore you had the pain. It lasted a few years, and then things got to where they needed to be. The equilibrium got reset. Is there no mechanism in China for that to actually happen?
You could allow it to happen, but you can prevent it from happening too, because liabilities are completely controlled within the banking system by the regulators. So you can never get a bank run. So what should you do? Well, I don't need to tell you, because this is typical in the Anglophone economies. You get these rapid adjustments, prices collapse. Is that a good thing or a bad thing? Well, in the short term, that's very difficult. But in the long term, it's probably a good thing. Remember, when prices drop, the economy isn't getting poorer, because the wealth of an economy is the total value of goods and services it produces.
Right.
Up and down real estate prices don't affect it. But if real estate prices drop, obviously there are losers, people who own real estate, particularly people who own them for investment purposes, which means by definition there are winners. And who are the winners? People who are short real estate, poor people, young people, students, etc. So a collapse in real estate prices is probably good for the economy in the medium to long term, because it shifts money, it shifts wealth from the rich to the poor, right? But China is different, because Beijing believes, and probably correctly, that politically they cannot absorb the social impact of a collapse in real estate. So they will do everything they can, and they're doing everything they can to slow down the adjustment process. So this could take many years.
Okay. So on a connected issue, I mean, one of the things that seems to be true, in Chinese society is essentially that normal citizens are required to basically effectively fund their own retirement and their own long-term healthcare needs, which for even middle-income countries is something that normally, especially you would, with China being a communist country, you would expect that to be, say, a state-provided, at least partially provided service, but it's not, and that would drive, as part of the reason for driving up the savings rates required by individual families to fund that. So what's the, I guess, what's the cultural or social thinking behind not having that safety net built into the system?
Yeah, it's a strange thing because as a nominally communist country, you would assume that these types of things would be quite common. And yet the attitude of the top leadership, quite honestly, I think even President Hoover back in the 1930s would have found them too right-wing for his taste. The
Mm-hmm.
argument is that if you give anything to the people, they will become lazy. They have to work for it. And things like
Mm-hmm.
pensions, social security, unemployment benefits, et cetera, they're terrified that by delivering that to the people, as Xi Jinping once said, that we'll become just like Latin Americans, we'll become lazy. The other problem is that the way all of these benefits are distributed are by the local governments. It's provincial or municipal governments that distribute it, and each one of them has a different level. So it's very hard to coordinate among them and say you must all, basically they could double pensions and the pensions would still be barely adequate. But
Okay.
who's going to double the pensions? It's got to be the local governments because they pay for it and they don't have the money. Um, so could it be the central government? Yes, but that means a complete reform of the entire pension system. And then it becomes very hard to discriminate because in China, you don't get the same pension. If you live in Shanghai, you get a higher pension than if you live in a secondary city. If
Okay.
you're a farmer, you get a lower pension than if you're an urban citizen. So you would have to fix all of that at the same time. And I think it's they're thinking about it, but it's a huge task.
So, I mean, and that segues into the demographic issue in China, which, I mean, obviously many people are aware of. The population had a small decline last year, but that's just the first of what will be effectively, inevitably, one every year for the rest of the century, I would think. And yet, at the same time that's occurring in the labor force, in theory, the labor force has shrunk in the last 10, 12 years. And yet you've got a youth unemployment rate of 21%, but a basic unemployment rate of 5%. So why aren't there jobs for such a large percentage of young people, given the shrinking of the labor force itself? You would think the demand would be huge.
Most problems in China, if you keep pulling the thread, you get back to low consumption. And in China, that matters because with growth being so investment intensive growth isn't really labor intensive. Uh, Services and consumption intensive growth is labor intensive. So you've got all of this growth in China, but very little of it is driven by consumption and by small
Mm-hmm.
businesses. And a lot of it is driven by investment, building bridges, et cetera. So it doesn't create the kind of jobs that you need, the amount of jobs or the kind of jobs. I remember a few years ago when China was growing at 8%, an economist did a really interesting study, and he said that when Brazil grows at 3%, it generates as much employment growth as China growing at 8%.
Oh,
And
okay.
the reason, of course, is the nature of that growth. Brazilian growth is much more labor intensive. So we need to shift the type of growth, which is the basic problem in China. The solution to almost every problem is to shift income to increase the consumption share of GDP.
And and is there going to be, can you imagine a policy change at I guess it would have to be the national level, to say we're going to find a way to get the consumption percentage of GDP up, because that other aspects, as you point out, the investment aspect is not going to get that driven. It would appear at the same time, the trade surplus issue is not going to get it driven up either. So consumption is pretty well the only thing left, is it not?
Yeah, and John, it's not really a choice. Um, The world invests roughly 25% of GDP, and consumption is the remaining 75%. And if you look at the distribution among different countries, countries like the US, Canada, the advanced economies, they tend to invest less because they're already capital rich. They tend to invest 18 to 20% of GDP. If you look at the high investing countries, they tend to be developing countries in the midst of their growth boom,
Mhm.
and they invest 30, 32, 33% of GDP. So that's the range from
Right.
from
Okay.
the high teens to the low 30s. China invests 44%. No country in history has ever invested this much, except China itself 5 years ago when it was investing 47%. This is just way too high, right? So, you know, assume China is able to maintain this level forever. What that means is that debt will grow infinitely. And it also means the rest of the world will have to reduce its investment to accommodate the high levels of investment in China, because the
Mhm.
world can only absorb 25% of GDP in investment. So that's not going to happen. Investment has to come down in China. And there's only three sources of demand: investment, consumption, and the trade surplus. The trade
Yeah.
surplus is too small to make a difference. So, by definition, if the investment share comes down, the consumption share must go up. But there are many ways that can happen. A terrible way would be the way the US did it in the early 1930s. In the first 3 years of the decade, American GDP contracted by 35%. Household income and consumption contracted by about half that, right? It's brutal, but it adjusted, it rebalanced. Consumption became a bigger share of GDP. Another way you can do it that has been done historically is what I call the Japanese way. And what happened in Japan is that before 1990, GDP grew at around 4 or 5%. Consumption grew below that. It was an unbalanced economy.
Hmm.
After 1990, GDP growth dropped to 0.5%, but consumption only dropped by about a half to 1 percentage point. In other words, consumption grew faster than GDP, right? So Japan rebalanced, but it was a very slow rebalancing. And over 30 years, they still haven't fully rebalanced. So historically, those are the two ways you can do it. In theory, there's a third way. If you could figure out how to get consumption to grow. So before COVID, consumption was growing at 4%. Let's say they can figure out how to get consumption to grow at 7%. In that case, you could have GDP grow at 4%. And again, China rebalance over a 10-year period. But no country has ever been able to do that. And it's quite hard to figure out how China is going to do that. But one way or another, they will rebalance. You cannot have 44% of your GDP invested forever.
So, I mean, there's kind of an implication from that. Right now, for years, people have been talking about not if, but when China's a notional GDP would exceed that of the US. But following this premise and also looking at the other factors, the demographic factors, and all the other things that go with it, it would appear that it's more likely that China will end up with this nominal GDP that is much like Japan, which still works because, of course, while it doesn't rise over 30 years, the population is shrinking. So the actual wealth, income, and consumption ability of the average Japanese is better than it was 30 years ago, even
Yeah.
though the GDP isn't changing. So is that what we should expect here in China's case, in that it will kind of get into this stall zone and while this rebalancing, reorganization of the economy takes place?
I think that's very likely. I think that's the most likely scenario. In that case, it'll be very hard to imagine GDP growing at much above 2 or 3%.
Mhm.
And you're right, it won't overtake the US. By the way, I never believed that it would. People forget, but in the late 1980s, everyone knew Japan was going to overtake the US in
Mhm.
two
Right.
decades.
Right.
People also forget that in the 60s, everyone knew the Soviet Union was going to overtake the US by the 1980s. John Samuelson put it in his textbook, in his 1961 textbook. He said
Yeah.
1984, the Soviet Union will be the world's largest economy. And they all followed very similar growth models. So we were making the same mistake we've made two times before by sort of drawing a straight line and saying growth will continue at this rate forever. I think it's very unlikely. I think growth rates will slow significantly. There is a small risk of a crisis. I think it's unlikely, but it can always happen. You can never predict. And there is a possibility that they get the mechanics right and they're able to cause an acceleration in consumption. The way to
Yeah.
do that is the government owns a lot of assets. And if they take those assets directly or indirectly and give them to households, then
Right.
household wealth will rise very quickly. So they could pull it off, but they've been talking about it for years. It's really hard to do. It's politically very hard to do.
So when you talk about household wealth now, I mean, real estate has always been the go-to place for people, for Chinese families to build wealth, and that's been at the expense of the stock market. Now, it's not like real estate isn't relevant in North America or Europe, but the typically, especially in terms of passive savings, traditional things like mutual funds, investing in bonds and stocks and things like that is where the bulk of the wealth is. But that does not seem to be the situation in China. Is that going to change now that the real estate markets are not providing the likely returns going forward? Is it more likely to see more capital go into traditional investments?
It could be. I expected the stock market to do much better this year than it did.
Yeah.
For exactly the reason you're saying. I thought they're not going to invest in real estate, and they're not. They've got all of these forced savings from the COVID period,
Mm-hmm.
so they'll lift it out of the banks into the stock markets. They didn't. They
Mm-hmm.
left it in the banks, which shows you how nervous people are. People are really worried about
Right.
prospects. You're right about the importance of real estate. Real estate, the studies suggest that total household wealth, between 60 and 70% of it is real estate. In the
Mm-hmm.
US, about half that. In Canada, it's a little bit higher than the US, but in both cases, they're much, much lower. So that's one of the things that we don't really know. The only comparable we have is Japan in the 80s, when again real estate was about 70% of the wealth of the average Japanese household,
Mm-hmm.
and that's not a very optimistic precedent, because we saw what happened in Japan.
Well, yeah, and of course, I mean, Japan actually went through again the super bubble on real estate, and it did collapse. So I mean, I guess the Japanese government left market forces to do what they were going to do, and then it stayed collapsed, right? And
Yeah,
and the same thing's
it's
true
down
with
80%.
the equity markets, right?
Yeah, it went down a lot. We're both old enough that we know that when you're in the midst of a real estate bubble, everyone will tell you this is not a bubble. This is sustainable and permanent,
Right. Yeah.
and it never is. And Japan was supposed to be permanent. I grew up in Spain. The Spanish real estate bubble, I can't tell you how many people told me, no, you don't understand. This is special. It's always special until it stops being special.
Till it's not. Exactly right.
Yeah.
But we haven't talked much about trade surpluses and deficits and stuff like that. But given the size of the Chinese trade surplus over many decades and the huge amounts of trade deficits in the U.S., at the end of it, is this model of it, the mercantilist model that the Chinese have about trade being a key component of their economic growth, is that something that's sustainable, or are we going to see changes here?
I think we'll see changes driven by the US, Canada, the UK, and Australia, which are the countries that are forced, because of their open capital markets, to absorb the trade surpluses of the rest of the world. I think the part that people often forget is that trade surpluses are not natural. In a well-functioning trading environment, the more you export, the more you are rewarded, and your reward is more and more imports for each unit of export. That's the reward for being efficient at trade. If you're running a surplus, that's not because you're efficient. It's not because you're productive. It's not because you're hardworking. If you're running a surplus, it's because the worker's share of wages are so low that they cannot consume a significant portion of what they produce. Surpluses, persistent surpluses, just mean that that local manufacturers are competitive because of policies that suppress domestic demand. Basically, if you keep wages low, if you have negative real interest rates, all these things that transfer money from households to subsidize manufacturing, your manufacturing becomes very competitive, not because you're efficient, but simply because you're so heavily subsidized. But those subsidies are paid for by the household sector, which means that they can't consume everything you produce. So you have to run a trade surplus. The trade surplus is evidence that domestic demand is very weak. And that's the problem in China. Now, why does that matter? It matters because if one group of countries runs surpluses in order to make their manufacturing competitive, then another group of countries has to run deficits. And the countries that run deficits, it turns out, are not the lazy countries that love to consume of cliche. It's the countries in which surplus countries want to hold their surpluses. So if you export something, $100, you have to use that $100 either to import something or to buy assets abroad.
Mhm.
And since you're not importing, you have to buy assets abroad. And where do you buy assets? Well, the so-called Anglophone economies have the deepest, most flexible financial markets. They have the best governance, the most protection for property, et cetera. So you buy assets in the US, the UK, Canada, and Australia. Those four countries collectively absorb 70 to 80% of all of the excess savings of the surplus countries. Now,
Okay.
if they were developing countries, you could say, okay, fine, they need the capital. But these are the richest countries in the world. They don't need the capital. They get the capital because the rest of the world dumps their savings there. So this creates a real problem for countries like the US, because that means that either they have, by absorbing those savings, either they have to allow unemployment to go up or they have to allow debt to go up. And I don't need to tell you, in the US, in Canada, and the UK, debt has soared in the last few decades. So I
Yeah.
think we're going through a major adjustment there, in which the deficit countries are becoming increasingly unwilling to run the deficits that the surplus countries need to resolve their domestic problems. And once that happens, surplus countries cannot resolve their domestic problems with surpluses.
Okay. So, Michael, I mean, it would suggest that, I mean, coming back to the very high investment rates in China, that the pressure from the rest of the world to have China significantly reduce that investment, increase consumption, create some kind of rebalancing, which in turn, paradoxically, would also potentially solve the youth unemployment rate, because essentially then presumably that consumption would be occurring at an average citizen level, and now goods and services and other basics as opposed to pure manufacturing would be part of that equation, would it not?
Well, it depends on how quickly and forcefully the government reacts. Because let's say the world stops importing, stops allowing surpluses, stops running deficits. This happened in the 2008, 2009 crisis. Global deficits collapsed. And as global deficits collapse, global surpluses collapse. China's surplus went from 10% of GDP to 3% of GDP. It was a huge collapse. Now, the surplus by definition is the excess of savings over investment.
Mm-hmm.
So when the surplus collapses, the gap collapses. And there's two ways the gap can collapse. One way is with an increase in investment, and the other way is with a reduction in savings. Now, investment won't go up, business investment won't go up, because when your export markets collapse, you don't invest more, you invest less. So if investment goes up, it must be government investment. But the government doesn't want to invest because so much of that investment is non-productive. So they
Mm-hmm.
would prefer savings to go down. So how do savings go down? The good way is if there is a massive transfer of wealth to the household sector and they immediately consume more. There's another way, and that is get the banks to lend to the households so that they borrow more money and consume, but that's not sustainable. And then there's the third way, the most likely way, unfortunately, and that is as Chinese manufacturers were no longer able to export, they had to cut back on production and fire workers. And an unemployed worker has a negative savings rate. So that's how
Right.
you adjust with a rise in unemployment. Now, obviously, they didn't want that. So they were left with only one solution, which was a massive increase in government infrastructure spending. Many people would argue that that's when the problems began in China. I think that's wrong. I think they began earlier, but they certainly exploded during that period. So that's the problem. If there's a rapid adjustment in global imbalances, that puts enormous pressure on surplus countries to adjust domestic demand. And unfortunately, one way of doing it is with a surge in unemployment.
So that's interesting because basically that's essentially what the American response was during the 30s with the New Deal. I mean, effectively, there was an increase in unemployment. They did invest in infrastructure. It did actually work, and it made the difference. And since nobody was competing for money, it didn't really change the cost of debt in any significant way.
Yeah, in the US, we saw that collapse in demand, partly domestic, partly external. And we had to respond either with a surge in investment, and businesses were not investing. So it had to be government investment, but that took many years.
Mm-hmm.
The alternative was a surge in unemployment. And that's exactly what we got. You look at Spain after 2003, when the German surpluses exploded. That's when the Spanish and Italian and Portuguese and French deficits exploded.
Mm-hmm.
And the only way Spain could balance those deficits was either with rising debt or rising unemployment. Before 2008, Spanish debt exploded. After 2008, when they could no longer borrow, Spanish unemployment exploded. So
Right.
that's basically the trade-off you get, debt or unemployment.
Okay. So one of the things I think I remember you commenting on, talking about the U.S. dollar and it being the world's reserve currency, is that it would be in the U.S. interest if it wasn't the world's reserve currency. Maybe you could explain why it's a benefit to the U.S. to not be the reserve currency.
Sure. Well, the problem with the dollar as the reserve currency is that if you have a surplus, you invest it in American assets. You buy American real estate, farmland, factories, stocks, bonds, whatever, or Canadian or English or Australian. All of these countries have the same problem. That means that the US must run a capital account surplus. Foreigners are investing their capital in the US. And if you have a capital account surplus, by definition, you must have a current account deficit. The US runs a current account deficit not because Americans like to consume, but because foreigners like to park their excess savings in the US. Same thing with Canada, by the way. Now, is that a good thing or a bad thing? Well, when the US was a developing country, those foreign savings allowed it to invest more than it otherwise could have. So it grew rapidly. So again, remember, when money comes into your country, the gap between investment and savings grows. If investment grows, that's great. You're going to grow more quickly. But advanced economies like the US, Canada, et cetera, they don't have a savings constraint. Businesses in these countries were able to borrow at negative or almost zero interest rates. They're sitting on huge piles of cash. They're not interested in investing because there's no demand. So if investment doesn't go up when money comes into the country, savings must go down. And how does savings go down? Either through higher unemployment or higher debt. So what we argue in my latest book is that it's not that the US benefits or suffers from dollar dominance. Certain sectors in the US benefit. Wall Street benefits, financiers with movable capital benefit, and the foreign affairs establishment benefit because they're able to impose dollar sanctions. But that comes at a cost to American workers, American farmers, American middle class, and American businesses. So I would argue the strength of the US is the economy, not Wall Street. And so we are better off with less use of the dollar. Wall Street will scream, but American workers and American businesses will be better off. By the way, I don't want to belabor the point, but Canada has exactly the same problem.
Yeah, I mean, one of the things that's occurred in the last few years in Canada, and I think to a lesser degree in the US, but it seems noticeable to Canadians, is foreign capital coming in and specifically going into the housing market and creating a lot of policy issues that have changed offshore investing and special taxes on housing not owned by local residents, et cetera, et cetera. So is this part of the manifestation of this excess capital coming in and say, well, what are we going to do with it? We might as well buy a nice view condo in the harbor in Vancouver or something like that.
That's one of the mechanisms, because remember, as money comes into Canada, Canada must run a deficit. And one of the ways it'll run a deficit is by something driving up consumption. Now, that could be debt, but it could also be a wealth effect. We see this in a lot of countries. We saw this in Spain too. As all of this money comes in, it causes real estate prices and stock prices to soar. And that means if you own real estate, you feel temporarily richer. You feel
Yeah.
permanently richer, but it's only temporary. And as you feel richer, you typically respond by consuming more than you normally would have. So your savings rate goes down. So it's a problem. Canadians are consuming more than they normally would because they feel richer than they are because of these very high real estate prices. If real estate prices stay there permanently, you would say, okay, well, they are permanently richer. But as we know, when real estate prices soar like that, eventually they come down. So Canada will eventually pay for these inflows in the form of much lower consumption.
Yeah, and it connected to that, I mean, both in I'm not sure about so much about Europe, but certainly in Canada and the U.S. right now, we have a significant inverted yield curve, which in theory should be a precursor to a recession, but that recession seems to get delayed as unemployment stays low and consumption continues to almost continue on unabated. It's like it's almost like waiting for that shoe to drop, but it hasn't so far. At the end of it, how dangerous is, say, this current environment where we're ignoring, the impact of very significantly higher interest rates?
It's hard to say. One of the things I like about focusing on China is that it's much more rigid, so it's easier to predict the way unbalances evolve. In the great strength of the U.S., of Canada, is that they tend to be fairly flexible, and so you get these rapid adjustments, which make it much more difficult to predict. But I would say that I've been impressed with the relative strength of the U.S. economy. A lot of us thought it was going to be much worse a couple of years ago.
Yeah, and yeah, is there going to be any impact, again, coming back to the trade deficit issues? This more and more talk. I mean, there are some geopolitical issues related to the war in Ukraine, and obviously between China and the U.S. that is causing businesses to say, should we nearshore, should we reshore? Like, will that have an impact on where these deficits and surpluses are occurring?
Only if the US, together with the other Anglophone economies, decides to change the global trading system. A lot of people talk about businesses moving out of China, but it's
Mhm.
hard to see that in the data. Chinese exports are growing. The Chinese manufacturing sector is growing relative to the rest of the economy. And I would argue the reason is because you're not in China because, out of happiness or friendship. You're in China for a very specific reason. Chinese manufacturers are so heavily subsidized, directly and indirectly, that they become much more competitive than manufacturers in the rest of the world. That's why you locate your manufacturing in China. So to the extent that certain countries remove their manufacturing for political reasons, they'll simply be replaced by either Chinese or other foreign manufacturing. You look even at something like infrastructure. I complain a lot about how infrastructure is a deadweight loss to the economy. But while it's a loss to the economy, all of this spectacular infrastructure, China's got great infrastructure. And while it's a loss to the overall economy, it's a huge subsidy for businesses, an enormous subsidy, because you've got, really good transportation facilities. The way I think about it is, we had the Winter Olympics here a couple of years ago, and there's a village in the north of Beijing where much of the Olympics was held, and they built a beautiful high-speed train to that village, incredibly expensive, right? Now, this makes no economic sense. They did it, for the Olympics, granted, understood, but economically, it makes no sense. There are not that many people who ski, and those of us who ski tend to be fairly wealthy. We can pay our own way. But we got this wonderful gift from the Chinese people of a heavily subsidized, high quality transportation system to the ski resort. So the way I think about it is China lost money, but skiers benefited. I benefit because I can
Yeah.
get there very cheaply and easily. And it's the same way with businesses. Even though the economy overall has lost because of this high quality infrastructure, If you're a business, that's not your problem. You benefit from this high quality infrastructure because it lowers your costs. And then, there's no labor rights, interest rates are very low, et cetera, et cetera. So the reason you produce in China is because you are much more competitive than anywhere else because of all of these direct and indirect subsidies. And that's not
Okay.
going to change in the near future.
So let me, this has been a great discussion we've had, Michael. I appreciate it. And I know we have to bring it to a conclusion, but let me ask you this, coming back to an investment question. If we look at it from our perspective, so we're a wealth management firm and we want to deploy capital, whether it's in real estate or public, private equity, private debt, like all of these different asset classes. Now, when we think about China, we wonder, is China investable given low market returns? And I'm not talking about the returns that have been earned on publicly traded shares over the last 30 years, not over the last 10 years, but basically it's virtually zero. And the political risk that's occurred. So number one, is it investable? And if so, what would the sectors be? Like what sectors would a Canadian investor want to consider investing in China in? Where's the competitive advantage specifically?
Sure. I can't really talk about the politics of it because I have no real way of judging it. And I think every investor has to decide how much political risk he's willing to take. But from an economic point of view, I think the really important story here is that there is no longer a China story. When China was growing at 10%, the good parts of China were growing at 13, 14%. The bad parts of China, consumption-related stuff, were still growing very quickly. They were growing at around 7%. So whatever business you were in, you had to be in China because every part of it was growing rapidly. But that's not very common. I mean, we don't talk about the American story or about the European story. You talk about sectors. And I would argue that that's how we have to start thinking about China. GDP growth is going to slow very sharply, but that doesn't mean everything is going to slow sharply. Investment-related growth is going to slow much more sharply. If you're producing cement, you're probably not in good shape. But consumption growth will not slow nearly as sharply. In theory, China could keep consumption growing at 4%, even as GDP is growing at 2%. That's what happened in Japan, right? 4% growth in consumption is pretty good. So you want to be in areas that benefit from the rebalancing of growth in China. Growth will drop, but it won't be uniform. Something will continue to grow. Other things will drop sharply. The other thing that I think, and that's not just for China things, because China matters to the rest of the world. So if investment growth goes negative, then Chinese imports of iron ore will collapse. And so if you're Brazil or if you're in Australia, you're going to be affected. The other thing is that we have to stop thinking about China. There's really two Chinas, right? There are 6 or 7 provinces on the east, Zhejiang, Shanghai, Jiangsu, Guangdong, Fujian, Beijing, Tianjin, that are quite wealthy. They're not quite South Korea, but they're not far from South Korea. They have diversified economies. They have growing working populations because of immigration. And they have debt problems, but except for Tianjin, they're not insurmountable debt problems. The rest of China, which is about 2/3 of the population, is really in serious trouble. It's much poorer. It's much less diversified. It has unsustainable debt levels, and their working populations are shrinking very rapidly, partly because of low births, but partly because of immigration to the faster growing parts of China. So I would say you want to pick where you're going to be. Parts of China will do well, parts of China will do poorly, just like any other large economy. And that's really how you're going to have to think about China.
Okay. Well, listen, Michael, your insights into China and what's going on are enlightening and in some ways kind of counterintuitive. You really do have to think about, what you're saying and reach the conclusions that you've reached. But we really appreciate you taking this time with us today. This has been a really amazing discussion. So thanks again.
It was my pleasure. Thank you very much. And
all right.
Good night from rainy Beijing.
All right. Thanks, and Michael. Bye-bye now.